Hi, my name is Walden Yang.
Hi, my name is Nicholas Yarnell.
Hi, I'm Daniel Thar.
And I'm Alvin Guo, and we are the Dividend Aristocrats.
As Mrs. Sohoni said in an interview in 2015, storytelling is a powerful tool. In business, it is the most important and first thing you will do in developing your company. Every great company tells a story of problem and perseverance, a story of setback and solution, of hardship and heart. With this in mind, we are proud to introduce you to our own unique story, the Dividend Aristocrats story.
Every story has a protagonist. In our story, it's Mrs. Reshma Sohoni, founder of one of the most successful seed funds in Europe. However, the strenuous nature of her work means that she no longer has time to manage her family's finances. As such, we have been tasked to develop a strategy for her. However, before we can begin tailoring a strategy, we must first profile our client to identify her needs. Mrs. Sohoni is a middle-aged woman of 42 with 2 children, 2 and 7. According to her, she loves numbers and loves people. Financially, she outlined 2 objectives. 80% of her portfolio must be dedicated towards long-term wealth creation, and 20% towards a short-term portfolio to help finance her husband and her African safari business. To break her long-term objectives along clearer maturity horizons, we split the 80% into 2 smaller goals: financing her children's education and financing her retirement.
To address these goals, our team devised the portfolio for earnings, education, and retirement, or PEER, named after the British aristocratic system. PEER consists of 3 independent sub-portfolios called peers, each tailored to address one of our 3 distinct objectives, and each figure headed by an aristocratic figure. The first peer, earnings, is designed towards meeting the liquidity requirements necessary for her safari business. This portfolio uses technical analysis and a machine learning algorithm to generate earnings within a 1 to 2 week time frame. Next is the education peer, designed towards meeting the financial demands of her children's education. This peer uses growth-style investing to generate wealth within a 10 to 15 year time horizon. And last is the retirement peer, designed towards financing her husband's and her retirement. This peer utilizes the principles of value investing to generate wealth within 20 to 30 years. That being said, I would like to first speak to the earnings peer. In the earnings peer, we sought to use a variety of technical indicators to select stocks to invest in for the short term, aiming for a 1 to 2 week holding period. In the beginning, we manually reviewed each security individually, checking first to see that the RSI value is below 50. However, we found that this process was very inefficient and could actually be automated, so we devised PyBot, a Python algorithm which calculated the RSI value of every stock within the allowed trading list using its historical data, and then input those values into a nice spreadsheet which we could then sort from lowest to highest. The first iteration of PyBot also introduced the use of the moving average convergence divergence, or MACD, which was calculated and input in a similar fashion. After this first iteration was complete, we still were not satisfied. We thought that we could do better. In PyDot 2.0, we began to make use of both daily and weekly indicators to guide our judgment. In addition, we introduced our own in-house short-term equity scoring system. This scoring system weighted the raw values given by the indicators by how important we found those indicators to be in our determination of buying a stock, ultimately scoring each equity between 1 and 100, the higher the better. As we increased the number of indicators that we used, this scoring system became crucial. Through our trading period, we found that momentum was particularly indicative of whether or not a stock would gain value within our 1 to 2 week time horizon. As such, PyBot 3.0 introduced a variety of new momentum-based indicators, including signal lines, the momentum indicator, and multiple percent differences, all of which incorporated into our equity scoring system. Ultimately, however, our scoring system did not have a final say over whether or not we purchased a particular security. Rather, it only recommended certain stocks for a more stringent manual review, consisting of the parabolic SAR, Bollinger Bands, and Ichimoku Cloud analysis. If the security passed all of these tests, we felt comfortable in buying.
We then thought of another way to use our Python bot, compiling a dataset of candlesticks and indicators. This dataset was then used to train and evaluate a neural network to try to predict stock price movements. The specific architecture we used was an LSTM, or long short-term memory recurrent neural network. This family of neural networks, as opposed to classical feed-forward networks, are specifically designed to perform well in sequence and time-based tasks, such as natural language processing and audio analysis. In our case, the LSTM was designed to predict whether or not the price of a security will increase or decrease significantly over the next week, or whether it will stay relatively stable. In the end, the model is not actually used in our portfolio, as we found that it consistently output buy ratings, attesting to the difficulty of creating an automated model that can outperform the market. In our final report, we discussed how if we were allotted more time, we would work on trying to make this model more accurate. We first expanded the dataset to use all of the stocks in the S&P 500 and added additional indicators. Second, the model architecture was changed to a multi-layer LSTM, which we hope would allow it to capture more complex price patterns. This neurally trained network has shown improvement over the old model.
Next, constituting 25% of the portfolio is the education peer. As earlier introduced, this portfolio uses growth investing to generate earnings in 10 to 15 years. To apply the principles of growth investing, we first surveyed the landscape by looking at various demographic changes around the market, focusing on changes in population size, median income, and consumer trends. After ascertaining a few critical regions, we honed into markets within these regions that would best benefit from those identified demographic shifts. Lastly, within these markets, we sought out the companies best poised to capitalize upon favorable market and demographic changes. These companies were usually the largest, had the most available capital at their disposal, and had already laid the foundations to grow upon.
Our last and largest peer is the retirement peer, represented by royalty. With a time horizon of upwards of 30 years, the retirement peer uses value investing to pick companies to invest in for the long run. As with the education peer, the first step was envisioning markets likely to grow significantly. After picking these sectors, we ran a screener to filter out the prospects who had large market caps and low PE ratios relative to their sector, noting Fama French's high minus low premium for value stocks. The remaining companies were subjected to a SWOT analysis. As we gathered information about each company, we also slowly began to piece together each's story. When our stories were complete, we moved on to intrinsically valuing each company using a discounted cash flow model, or DCF. Rather complex in nature, this process is best explained by demonstration. Here, we will demonstrate the valuation and ultimate selection process for AbbVie. Let's begin at the top. Currently, the singular largest age demographic in the US is the 25 through 34 age group, comprising 14.1% of the total population. Over the next 30 to 40 years, this demographic will age, and as it ages, it will need medicines. With healthcare spending rising alongside demand quantity, we expect significant profit growth for companies in this market. Noting this, we began to screen companies in this sector. One company which stood out was AbbVie, with its large market cap and lower than industry average PE ratio, usually indicative of being undervalued. After screening and narrowing down our selections, we built SWOTs for the remaining companies. As we pieced together a story for these companies, one really stood out to us. Particularly, with its aggressive but successful acquisition history, we found AbbVie to be well positioned to capitalize upon such an expansion, so we began to value. We used the capital asset pricing model to arrive at the cost of equity, and we used an outstanding 5-year bond yield rate as the cost of debt. After appropriately weighting these and adjusting for the tax shield, we calculated the weighted average cost of capital. This is our discount rate. Next, we began the fun part, forecasting out the cash flows. To do such, we first calculated the unlevered free cash flows for the years in the past, which we converted into the EBIT and finally into after-tax operating income. From this operating income, we were able to derive the reinvestment rate as well as the return on invested capital. The product of these two was our EBIT growth rate, 13.05%. Using this, we forecasted out our EBITs for the next 5 years. After readjusting for capex, depreciation, working capital, and the sort, our EBITs became unlevered cash flows, which we then had to discount to the net present value. The sum of these projected NPVs was just over $3.7 billion. Finally, using a modified Gordon growth model, we calculated the terminal value for AbbVie as $241.5 billion. Summing together the NPVs and the terminal value, we arrived at an enterprise value of $245.3 billion. After adjusting for non-operating assets, debts, and minority interests, we retained an equity value of just under $220 billion, which, when divided by the number of shares outstanding, yields an intrinsic share price of $123.54, significantly greater than the market price of $88.69 per share. Hence, we determined that AbbVie was undervalued, so we bought it.
After we devised the peer portfolio, we decided that the best way to organize our team was to divide and conquer. We decided that the earnings peer should have 2 analysts due to the sheer volume of securities needed to be processed every day. The other 2 analysts worked on covering the education and retirement peers, as these 2 peers had many overlapping features. At least once a week, the team would meet in a full meeting to discuss what each duo accomplished during the past week. These meetings allowed for members of both subteams to familiarize themselves with what the other subteam was doing. Overall, our Otis experience was amazing. Wharton created an environment for us to flourish in, and we surely did not take this opportunity lightly. From learning about technical indicators to performing DCF analysis to qualitatively projecting a company story, this competition provided us with the opportunity to learn a lot about finance. If we were given the opportunity to do this again, we would love to meet with industry professionals to help us perfect our strategy and teach us some methods used in the professional field. With this in mind, it's important to recognize the skills we learned beyond just the field of finance. This experience afforded us the opportunity to work together as a team. We learned how to negotiate, how to cooperate. We learned how to be better team players and better world citizens.
And that brings us to the end of our story. Thank you for listening to our presentation and for organizing such an amazing competition despite the complications due to coronavirus. We are the Dividend Aristocrats, and it's been an honor.